Hello everyone, welcome to the 94th episode of me learning how to trade in Forex. So in the last video we went through the traded weight dollar index, which is basically created by the Federal Reserve and another kind of US dollar index. You can find it on the Federal Reserve Economic Data website. Also known as a broad index, is a measure of the value of the US dollar relative to other foreign currencies. There's loads of other foreign currencies used here, so for example we've got all the euros, China, Canada, Mexico, Japan, United Kingdom, Korea, Taiwan, Singapore, Brazil, Malaysia, Hong Kong, India, Switzerland, Thailand, Australia, Russia, Israel, Sweden, Indonesia, Saudi Arabia, Chile, Philippines, Colombia, Argentina. So that's all the countries used, which was last updated in 2019, but there's probably more, or the way of each country might be changed as well. Weights are based on the annual trade data, so basically the index is probably a better reflection of the US dollar's value across the globe. Weights for the index for the broad index can be found at the website here, and looking at historical data you can see it right here. So now that's out of the way, we're on to the Bloomberg dollar spot index. Bloomberg dollar spot index. Date is a third. So the Bloomberg dollar spot index. The Bloomberg dollar spot index, or BBDXY, tracks performance of a basket of 10 global currencies against the US dollar. So Bloomberg dollar spot index tracks the performance of a basket of 10 global currencies against the US dollar. Its composition is updated annually and represents a diverse set of currencies that are important from a global trade and liquidity perspective. The composition is updated annually and represents a diverse set of currencies that are important from a global trade and liquidity perspective. So this is the Bloomberg dollar spot index. Dollar strength green, back heads for all-time high and turmoil. 2016, 2017, 2018, 2019, 2020, level 1100, 1150, 1200, 1250. It says other dollar indices, DXY, do not update their composition and are comprised of only a handful of currencies with concentrated weights. Bloomberg claims that index provides a better measure of the US dollar. Bloomberg dollar spot index and the ICE US dollar index. So Bloomberg is the pink one, the ICE is the black one. We can see the Bloomberg one is lower in some cases than the ICE dollar index, and sometimes the ICE dollar index is higher than the Bloomberg dollar spot index as well. So the BBDXY index data starts from December 31st, 2004 with a base level of 1,000. The Bloomberg dollar spot index data starts from December 31st, so 2014, 2004, with a base level of 1,000. Each currency in the basket and its weight is determined annually based on its share of international trade and FX liquidity. each currency in the basket and its weight is determined annually based on its share of international trade and FX liquidity. So, currency rankings, trade weights, Federal Reserve from 2019, liquidity, BIS triennial survey 2019. Euro with a trade weight of 18.947%, rank 1, CNY, I'm guessing that's Chinese yuan, MXN, is that Mexico? Something, I don't know what the currency they use in Mexico is. CAD, Canadian dollar, JPY, GBP, KRW, that's Korean won, I think. INR, India rupees. CHF, right, okay, Euro, JPY, liquidity. Right, okay. A better measure, so Euro still comes out on top in both of these criterias. A better measure of the US dollar. Let's see how the Bloomberg Dollar Spot Index differs from the widely used ICE Dollar Index. The Bloomberg Dollar Spot Index is more representative. The Bloomberg Dollar Spot Index tracks a more representative basket of currencies by considering global currency market liquidity and trading partners of the US. So the Bloomberg Dollar Spot Index tracks a more representative basket of currencies by considering global currency market liquidity and trading partners of the US. Bloomberg Dollar Spot Index 2020 weights: Euro, JPY, CAD, GBP, MXN, AUD, CHF, KRW, CNH, that says INR. Global currency market liquidity and trading partners of the US. BBDXY is more diversified. Unlike the DXY, the Bloomberg Dollar Spot Index is not dominated by the euro. Alright, this is the ICE one. I was about to say, like, oh, here we go, okay. It also includes major emerging market currencies such as the Indian rupee, Korean won, Mexican peso, that's it, Mexican peso, and Chinese renminbi, which are all major trading partners of the US. So the Bloomberg Dollar Spot Index is not dominated by the euros. Oh, is that euro there? 32.65% JPY, CAD, GBP, MXN. Yep, that's the same chart as that, but in a not in a pie chart form, but not in pie chart form, but whatever this is. BBDXY is more dynamic. Unlike the DXY static composition, BBDXY is dynamic with an annual rebalancing process that captures the changing state of the currency markets. The I've already wrote it updated annually. The Bloomberg Dollar Spot Index has an annual rebalancing process which captures the state of the captures the changing state of currency market. Captures the changing state of currency markets. This results in an index that includes important currencies like the Australian dollar that rank higher in liquidity and trading versus the Swedish krona. This results in an index that includes important currencies like the Australian dollar that rank higher in liquidity and trading versus the Swedish krona. Why does the USDX include Sweden? Because the index is still living in the past. The ISC US dollar index measures the value of the US dollar against the basket of currencies of the top 6 trading partners of the United States, as measured in 1973. This includes the Eurozone, Japan, the United Kingdom, Canada, Sweden, and Switzerland. Here's a snapshot of how the Bloomberg dollar index has rebalanced over the years. Oh, I hate these type of graphs because like you can't even tell anything from these. Yeah, I'm not even going to bother trying to read that because I don't really know how to look at this. Notice how currencies like the Singaporean dollar and Brazilian real used to be part of the cool club, but eventually got the boot and were replaced. So that's the light blue one, Brazilian real. Guessing that's that bit there. BBDXY don't play around, it likes to keep it fresh. This is in contrast to the US dollar index where the currencies never change. Maybe they should call themselves the boring dollar index. Okay. Which currencies are part of the Bloomberg dollar spot index? Here's the most recent composition of the Bloomberg dollar spot index compared to the previous year. Most recent. So 2020 target weights Bloomberg dollar spot index. Euro. So Euro's gone up. Japanese yen's gone down quite a lot, minus 3.4%. Canadian dollar, yeah, not that much change, not that much change, not that much change, not that much change, not that much change. So Euro and I guess 1% is a bit of a change. The British pound, the yen and the euro have changed a lot. And the Indian rupee to some sense as well. How the Bloomberg dollar spot index determines which currencies to include. The index rebalances once a year to incorporate new data from the annual survey of major trading partners versus the US dollar as reported by the Federal Reserve. The triennial survey of most liquid currencies is reported by the Bank of International Settlements. So, this rebalancing includes new data from the annual survey of major trading partners of the major trading partners versus the US dollar as reported by the Federal Reserve. The triennial survey of most liquid currencies as reported by the Bank of International Settlements. Currencies pegged to the US dollar are excluded, and currencies heavily managed like the Chinese renminbi have their exposure capped. Pegged to the US dollar are excluded. Exposure capped. To ensure tradability, currencies with weights of less than 2% are removed. Now each annual rebalance, heavy managed have their exposure capped. currencies where it's less than are removed. At each annual rebalance, the following steps are taken to select which currencies to include their weights. Identify the top currencies in terms of trading activity versus the underlying currency. For the US dollar, this is defined by the Federal Reserve in its broad index of foreign exchange value of the dollar. Identify the top currencies from the triennial central bank survey of foreign exchange and derivatives market activity. Specific information about the foreign exchange turnover can be found here. Select the top 10 currencies of both lists but exclude any pegged currencies. For example, currencies pegged to the US dollar such as the Hong Kong dollar or Saudi Rial are removed for the Bloomberg dollar spot index. What does pegged to the US dollar mean? Assign a preliminary weight for each currency based on its trade weight and liquidity weight. Cap the exposure of the Chinese RMB and remove smaller currency positions defined as any position that has a weight of less than 2%. Voila, BBDXY calculation complete. The rebalancing target weights are applied after the close of the last US trading day in December every year. Right, so the rebalancing target weights are applied after the close of the last US trading day in December every year. Here's a chart that visualizes the above process. Steps to compute BBDXY members and weights. Federal Reserve's trade data, BIS liquidity survey, remove pegged currencies to USD. Average liquidity and trade weights, cap exposure of Chinese RMB to 3%, remove currency positions under 2%. But I'm probably going to make my own one for this one as well because there's not that much data or no explanation on which of the step does. So yeah, how to view the Bloomberg dollar spot index. For Bloomberg subscribers, you can run BDXY on the Bloomberg terminal to view the Bloomberg dollar spot index for Bloomberg subscribers. But if you can't afford to pay the 20,000 annual fee for a Bloomberg terminal subscription, you can access the live BBDXY quote for free on Bloomberg's website. What's the difference between the paid one and the free one? On Bloomberg's BBDXY page, you'll see a live quote that looks like this. You can even run a full chart. You can even view a full chart by clicking near the top right corner. View full chart here. As of 2020, you can also access the DXY quote on Bloomberg's website as well. What's the difference between the paid one and the free one? The dollar smile theory. Ever wonder why the US dollar strengthens both in times of tough luck and when the economy is booming like the Taylor Swift single? Currencies tend to fall when their country's domestic economic outlook worsens. But the US dollar's unique global role makes it special, so when the US economy isn't doing great, the currency may still rise. tend to fall when their country's domestic economic outlook worsens. But the US dollar's unique global role makes it special, so when the US economy isn't doing great, the currency may still rise. A helpful to look at why this is the case is to pretend there are two types of US dollars. There is a domestic US dollar that behaves like any other currency. It's linked to the it's linked to the economy's relative outlook and potential investment returns. There is also an international US dollar that is used as a primary currency used in global trade for payments, and is also needed to buy US government bonds which are coveted for their safety. This international US dollar strengthens for a variety of reasons when markets are volatile and global growth slows. When there is some sort of shock that happens, whether from the US or abroad, and it's big enough to cause investors and traders to panic and send financial markets lower, then it will likely cause the broad US dollar to appreciate. So the international US dollar to appreciate. In fact, this really smart dude who used to work at Morgan Stanley came up with a theory to explain this phenomenon. What is the dollar smile theory? Stephen Jen, a former economist at the International Monetary Fund and Morgan Stanley, who now runs the hedge fund and advisory firm Horizon SLJ Capital in London, came up with a theory and named it dollar smile theory. The dollar smile theory says the US dollar tends to strengthen against other currencies when the US economy is extremely strong or weak. So the dollar smile theory says the US dollar tends to strengthen against other currencies when the US economy is extremely strong or weak. The dollar smile theory explains. The dollar smile theory is based on two assumptions. When the US economy significantly outperforms the rest of the world, the US dollar tends to be strong and increase in value relative to other currencies. When the global financial markets are disorderly or crashing and sentiment switches to risk off, since the US dollar is perceived as the ultimate safe haven currency, everyone rushes to safety and starts buying USD, causing it to rally. Safe haven currencies. The dollar smile theory is based on two assumptions. When the US economy significantly outperforms the rest of the world, the US dollar tends to be strong and increase in value relative to other currencies. When the global financial markets are disorderly or crashing and sentiments switch to risk off, since the US dollar is perceived as the ultimate safe haven currency, everyone rushes to buy the USD and causing it to rally. His theory depicts three main scenarios directing the behavior of the US dollar. Here's a simple illustration. USD strengthens due to risk aversion, USD strengthens due to economic growth, USD weakens to new low due to weak economy. So this is the smile, I'm assuming. Scenario 1. There are three main scenarios directing the behavior of the US dollar. Scenario 1. USD strengthens due to risk aversion. The first part of the smile shows the US dollar benefiting from risk aversion, which causes investors to flee to safe haven currencies like the US dollar and the Japanese yen. Since investors think that the global economic situation is shaky, they are hesitant to pursue risky assets and would rather buy up safer assets like the US government debt, US treasuries, regardless of the condition of the US economy. In order to buy US treasuries though, you need USD, so this increased demand for USD to buy US treasuries caused the US dollar to strengthen. USD strengthens due to risk aversion. So US dollar benefits from risk aversion due to which causes investors to flee to safe haven currencies like the US dollar and USD and JPY. Since investors think that global economic situation is shaky, they're hesitant to pursue risky assets and will rather buy up safer assets like US government debt, regardless of the condition of the US economy. Since investors think the global economic situation is shaky, they are hesitant to buy risky assets and would rather buy safer assets like the US government debt, regardless of the condition of the US economy. Therefore, USD is needed, which increases the demand for USD, causing the USD to strengthen. Scenario number 2. USD weakens to new low due to weak economy. USD weakens to new low due to weak economy. Dollar drops to a new low. The bottom part of the smile reflects the lackluster performance of the greenback as the US economy grapples with weak economic fundamentals. The possibility of interest rate cuts also weighs the US dollar down, although if other countries are also expected to cut interest rates, then this might be less of a factor since it's all about expectations of the future direction of interest rate differentials. This leads to a market shying away from the dollar. The motto for USD becomes sell, sell, sell. Lackluster performance of the greenback as the US economy grapples with weak economic fundamentals. Reflects the poor performance of USD due to weak economic fundamentals. This leads to the market shying away from the dollar. The motto for USD becomes sell, 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 leading to market shying away from dollar, therefore trying to sell it. Another factor is the relative economic performance between the US dollar and other countries. The US economy may not necessarily be horrible, but if its economic growth is weaker than other countries, then investors will prefer to sell the US dollars and buy the currency of the country with the stronger economy. The relative economic performance of the between the USD and other between the US and other countries would also affect would also cause the USD to weaken. Although the US economy may not be horrible, may not be bad, if its economic growth is weaker than other countries, investors will prefer to sell their USD to buy the currency of the country with stronger economy. It's kind of like if you owned an NBA team and had Reggie Miller as your star player. All of a sudden, a healthy Michael Jordan is available. Obviously, you would trade Miller for Jordan because on a relative basis, Jordan is the better performing player. It's not that Reggie Miller sucks, but there's just a better alternative at the moment. Now, if you make the trade and all of a sudden Michael Jordan has a season-ending injury and Reggie Miller just so happens to be available, then you know what to do. Dump Air Jordan for Miller time. See, it's all relative. Scenario 3. USD strengthens due to economic growth. Due to economic growth. The dollar appreciates due to economic growth. Dollar appreciates due to economic growth. Lastly, a smile begins to form as the US economy sees the light at the end of the tunnel. As optimism picks up and signs of economy recovery appear, sentiment toward the US dollar begins to pick up. In other words, the greenback begins to appreciate as the US economy enjoys the stronger GDP growth and expectations of interest rate hikes increases relative to other countries. Let's take a look at the dollar smile theory in reality. Dollar smile theory. Reality shows relative US ROW growth regimes do matter for the dollar. Average annual broad USD index change in each growth regime. Percentage 1985 to 2019. 1. USD safe haven flows into global recession. So this is the first scenario. USD strengthens due to risk aversion. Current 2020. 2. USD weakens when ROW outperforms US economy. 3. USD pro-cyclical flows under strong US growth. And now we're back onto here again. Right? Current 2020. So it's about to... So USD is gonna drop, maybe? What's this red dot? Broad real dollar. Broad nomio dollar. Global recession, slowing US growth, ROW growth and US recession, ROW growth outpaces US, slowing ROW growth, US growth outperforms. And expectations of interest rate hikes increase. You cannot see what that says, so let's just do that. As you can see, due to the global pandemic, which has caused a lot of economies all over the world to suffer, the US dollar is acting as a safe haven currency. All countries, including the US, aren't doing so great. But if the economies from the rest of the world, so that's what ROW means, can improve and start to grow faster than the US economy, then expect the US dollar to weaken. The key is relative economic growth. If growth from other countries is growing but the US economy is growing even faster, then the US dollar will swing upwards to the right side. So will the dollar smart theory hold true? Only time will tell. In any case, this is an important theory to keep in mind. Remember, all economies are cyclical. They strengthen, they then weaken, they strengthen, then they weaken, and repeat. So key is relative growth. If growth from other countries is growing, if growth from other countries is growing, okay, but the US economy is growing faster, growing even faster, then the USD will appreciate. Remember, all economies are cyclical. Economies are cyclical. They strengthen, they weaken, strengthen, weaken, etc. The key part is determining which part of the cycle the US economy is in and then comparing how it's doing against the rest of the world. Key part is determining which part of the cycle the US economy is in and comparing how it's doing against the rest of the world. A strong dollar's pros and cons. When a dollar is strong, this makes traveling for Americans to other countries less expensive. This makes traveling for Americans less expensive. Why does it make it less expensive? Oh, I'm assuming because if you're going to other country, that means you're spending money over there, right? To book the flight or whatever. So if it's strong, then you might get to pay less than if the dollar's weak. So if the dollar's weak, then you got to pay more to get that same amount if it was a strong dollar, if you see what I mean. So for example, if the dollar's strong, then you only might need to pay $100, but if it was weak, then you might need to pay $150 to get the same relative amount, if that makes sense. Is that even right? I don't know. And given how loud and obnoxious some American tourists can get, might not be a good thing. Also, the price for imported goods into the US also declines. When the USD is strong, traveling to other countries is cheaper. Price for imported goods also declines, so the stuff also gets cheaper. So for US consumers, it's great. Traveling to other countries and buying imported goods at home is cheaper, but for non-US consumers, it's not so great. It's more expensive to visit the US, like going to Disney World, and they have to pay more for imported US goods or commodities priced in USD. From the US. Price for imported goods to the US also declines. For non-US consumers, traveling to the US is more expensive. Price for imported US goods are also more expensive. Also, multi-international corporations generate a sizable percentage of their revenue outside of the US. This means that they'll experience a decline in profits when their revenue is exchanged from the local currencies to the US dollar. So multi-national corporations generate a sizable percentage of their revenue outside of the US. Therefore, local currencies to US dollars. Therefore, they'll experience a decline in profits when their revenue is exchanged from the local currencies to the USD. Okay. I am going to leave this episode here. So we finished off the US dollar index. In the next video, we're going to cover how gold affects AUD USD and USD CHF, which is in the intermarket correlation section. Well, thank you all for watching this video, and I will see you all next time in the next video. Goodbye.